All right, so now we want to look at how we assign overhead to a specific job. Either we assign it or allocate it, right? Now the thing with manufacturing overhead, we don't know a lot of our manufacturing overhead costs. We don't know the exact amount until later in the period or even the end of the period. And we're working all throughout the period on jobs for customers and hopefully selling them as quickly as possible, right, to get cash coming into our business. And so because we won't know till the end of the period how much overhead we're going to have, when we allocate overhead to a job, we have to estimate. We have to use estimates. And so the way we allocate overhead is by using an overhead rate, what we call a predetermined overhead rate. So we are going to calculate an overhead rate at the start of the period based on estimates. And then we will use that rate throughout the period to take a piece of that overhead and put it on to a job. So the way we calculate the predetermined overhead rate, we estimate the manufacturing overhead costs for the period. And then we're going to divide it by an allocation base, right? So we're trying to figure out a way how each one of our jobs can pick up their share of the manufacturing overhead. Ideally, all of that manufacturing overhead is going to be put onto one of our jobs, okay? But we're going to have to estimate it. So we're going to divide up the total estimated manufacturing overhead by an allocation base, which is typically direct labor hours or machine hours. And so if the process of making the product is more labor intensive, if it's a lot of workers putting together the product, then that would make sense that you would use direct labor hours. Direct labor cost could also be an allocation base, but we're not going to look at that too much. It's mostly going to be either direct labor hours, or if it's a highly automated process, if it's putting things onto machines and running the machines, then machine hours is going to make more sense as an allocation base to determine our overhead rate. After we have the overhead rate so it'll be a certain dollar amount per direct labor hour or a certain dollar amount per machine hour, then we're going to take that rate and multiply it by the actual direct labor hours or actual direct machine hours used for that specific job. So here's an example. We estimate that we are going to have $1 million of manufacturing overhead. And because our process is labor intensive, we're going to use direct labor hours as our allocation base. And we estimate that our direct laborers will spend 62,500 hours putting together our product. So to get our predetermined overhead rate, we're going to take the $1 million of estimated overhead and divided by 62,500 direct labor hours that we've also estimated. So when we divide that, we see that our manufacturing overhead is going to be $16 per direct labor hour. So we've got a specific job number 603, that's used 500 direct labor hours. So to get the allocated overhead for job number 603, we're going to take the $16 per direct labor hour and multiply it by the 500 direct labor hours that job 603 used. So when we multiply the predetermined overhead rate by the 500 direct labor hours, we come to 8,000. So 8,000 of the manufacturing overhead is going to be allocated to job number 603. So that's what we'll show on the job cost record for job number 603. And so if we're putting it on the job cost record, we also have to put it into work in process inventory. So we'll debit work in process inventory for the 8,000. We'll credit manufacturing overhead for the 8,000. And we would use that predetermined overhead rate to allocate manufacturing overhead to every single one of the jobs that we worked on. And so ideally, we would end up assigning all of our manufacturing overhead to specific jobs, that all of our jobs would pick up the total amount of overhead that we incurred. However, question is, what do we do if, and not if, when actual manufacturing overhead does not equal the allocated manufacturing overhead, right? It's not going to equal because we were dealing with estimates. We were estimating the overhead that we were going to incur. We were estimating how many direct labor hours or how many machine hours were going to be used when we came up with that rate. And so we're not going to be allocating the exact amount of overhead that was incurred. So when we get to the end of the period, we're going to have either a debit or a credit balance in manufacturing overhead because either we overestimated and we assigned more overhead to jobs than we actually incurred, or we underestimated and we assigned less overhead to jobs than actually were incurred. Right? So we've got two estimates that we're dealing with. We estimated the overhead costs, and our actual overhead costs are probably going to be different than what we estimated. We estimated either machine hours or direct labor hours, and the actual hours are probably going to be different. So with the amount that's either underallocated or overallocated, we're going to have to either adjust cost of goods sold for the difference, or we could adjust cost of goods sold, work in process inventory, and finished goods inventory. That would be the more precise way, because that's where the manufacturing overhead would end up being at the end of the period. Okay. We'll probably just we're going to just look at adjusting cost of goods sold, and that would be the method that would be preferable if there was not a material amount under allocated or over allocated. So it would depend on how off you were with your estimates, how much you have left over in manufacturing overhead at the end of the period. Because if we look at our T account for manufacturing overhead, right, when we did our journal entries where we were debiting, where we were incurring the overhead, we were debiting manufacturing overhead. And then when we finished a job, we were taking an amount out of manufacturing overhead and putting it into work in process for that specific job. So we were crediting manufacturing overhead when we were allocating it, right? In a perfect world, we would allocate the exact amount of the overhead that we actually incurred, and we'd end up with a zero balance at the end of the period in manufacturing overhead. But we don't work in a perfect world. So if we get to the end of the period and our actual manufacturing overhead is more than what we allocated, that means we underallocated the manufacturing overhead. That means we didn't put enough overhead on our specific jobs, which means our jobs are undercosted. So that's not good. We undercosted our jobs. We thought it cost less than they actually cost. So we probably undercharged our customers, right? Our pricing is going to be based on what we think it cost. Okay. So if we didn't allocate enough overhead, we're going to end up with an ending balance of debit in manufacturing overhead. And we're going to close the manufacturing overhead into cost of goods sold. So if it has a debit balance, to close it, we're going to credit manufacturing overhead, and our debit will be cost of goods sold. Okay. Because we want to zero out manufacturing overhead. Manufacturing overhead is just a clearing account, right? We hope to put it all into work in process, but we get to the end of the period. If we didn't put enough onto our work in process inventory accounts, we didn't put enough onto the jobs, then we just end up recording it as cost of goods sold. If we allocated more manufacturing overhead than we actually incurred, then manufacturing overhead is over allocated. That means we put too much manufacturing overhead on the jobs, so we overcosted the jobs. That's not good either. Okay. Because you're thinking, okay, well, we covered all of our manufacturing overhead, but if we're overcosting our jobs, right, we may be pricing our jobs too high, we could be losing customers, right? So we know it can't be perfect, but we want to get it as close as possible, okay? So if that happens, right, we put more on jobs than we actually incurred, we're going to end up with a credit balance in manufacturing overhead. So when we get to the end of the period, we want to close out manufacturing overhead. Since it has a credit balance, that means to close it, we need to debit it. We'll debit manufacturing overhead and we'll credit cost of goods sold. So this is why if it's a large amount that's been over or under allocated, that's when we're going to go and put some of it into cost of goods sold, work in process inventory, and finished goods inventory. For our purposes, we're just going to be looking at closing it into cost of goods sold. And then the last thing we need to look at, after we have allocated the overhead to the job, we finished the job, okay, and now we're going to move the cost of that job from work in process inventory into finished goods inventory. Okay. So you'll take the total job cost for the specific job, and you're going to debit finished goods inventory for the total amount of the job. You're going to credit work in process inventory for the total amount of the job, right? And then finally, we're going to sell the goods to the customer. So when we make a sale, this is what we learned back in financial accounting. We have to record the transaction with the customer. Debit accounts receivable for the amount we're charging the customer, right? Because whatever the job cost us, in this example, it's $108,000. Clearly, we're charging them more than $108,000. That's why we're in business, to make money on selling things to our customers. So we sell it for more than it cost us. So we debit accounts receivable, we credit sales revenue for the amount we charge the customers. And then we learned back in financial accounting, we have to update our inventory account. So we debit cost of goods sold for the cost of the inventory, and we credit the finished goods inventory for the cost of the inventory. So the finished goods inventory goes down because those goods are going out the door. They're going to the customer. So our finished goods inventory should be going down. That happens with a credit. So that's how job costing works.